our impairments are enhanced a little because there's been write-backs of provisions. But what it reflects is a really high-quality book. So we're very focused not on the quantum of the debt, but the quality of the debt, and that's not going to change. But we will see those impairments grow to maybe somewhere between 3 and 4% will be a more normalized figure for our business. But we're beginning to see top line growth in our financial services. We got nearly 16% for the year, so we're seeing better growth than we've seen for many years. We hope to continue to see that grow, to see growth in line with our turnover or slightly above. But what we expect to see is those impairments as a percentage still very low compared to others. We will still remain a cash as opposed to a credit retailer.
So taking a look at your balance sheet, you have 500 million rands worth of capex that you didn't spend this year, and it's going to roll over into the next financial year. What are you planning to do with that extra capex?
Yeah, I mean, our focus for our capital expenditure is really around our stores. We're trying to build a bigger business. We're building our existing stores bigger. We're opening newer, bigger stores. And the bulk of our capital expenditure, about $1.5 billion, is really focused on expansion of the stores. The rest is going to things like the enhancement of our systems, etc. But that $500,000 that's rolled over was just the delayed opening of some of those stores. So it will be incurred during the course of this year.
So am I hearing that we're not going to be seeing any kind of acquisitions in South Africa, at least in the near term?
We've no plans at this point in time. You know, I wouldn't rule out acquisition. We look at whatever comes across our books, but there is nothing in the balance sheet that is set aside for big acquisition.
Let's get into some strategy now. One of the things you're targeting is encouraging consumers to shop with a trolley rather than a basket. Maybe just explain some of the benefits this has for Woolies.
Look, our strategy in foods has really arisen not because of us, but because of our customers. Listening to our customers and hearing that what they want is they want more choice. They want to be able to complete the shop with us, and they want more choice of brands. They want more bulk, they want better value, and they want to be able to shop with a trolley, not a basket. And that's really important to us. And you know, having listened to that, what we've done is we've enhanced our catalogue, so there are more things on offer. So really expand our groceries business where we were I think falling behind the rest of the market, and we've really enhanced our long life business, our non-foods business. So we're more of a supermarket, more of an offer. Customers responding well to that. They're coming in more often, buying more items. And what your viewers won't see is there are 3 people who have just come in. They're shopping with a trolley, not a basket. So I'm very happy with that. And that's our intention, and it's working for us. You know, we're seeing well in excess of 20% growth in groceries and long life. We're seeing growth ahead of the market and consistently ahead of the market for a considerable period of time now. So we believe, having listened to our customers on choice, on price and on promotion, the responding is working, and we're building a bigger food business.
Because you hinted at it, you're also now offering bulk items. Maybe you can discuss that a bit more for us as well.
Look, we've gone in, everybody said the Woolworths customer doesn't want bulk. It's not true. Everybody wants bulk. It's convenience in the right items, isn't it? You know, you want bulk in things like toilet roll, in things like milk, in things like oil, and things like potatoes, and things like butternut. All of those things we've put into bulk. It's worked incredibly well for us, and what it hasn't done is diminish the sales of the smaller pack sizes. So we've just seen those categories really grow, and the customer likes it. You know, nappies is another one where we're getting mothers now coming in and saying, thank goodness Woolies are now selling nappies in bulk. Nobody wants to buy these things in small pack sizes, by and large. So by offering bulk, we've brought new customers in, and we're getting our existing customers to come in and buy more from us.
Sometimes rewards programs can hurt margins, and that's why I think it's sometimes a hard sell to management. How has Woolies responded to that?
Well, it was a bit of a difficult sell, and you know, the buyers they don't like giving up margin, but what they've seen is the volume uplift and the enhancement to their overall profitability over time is such that it really makes sense. So they're now totally committed. We've seen our margins grow overall. And it's been a very profitable, successful business. And importantly for the buyers, now they can see that we've got 67% of our customers tracked. It allows them to make better buying decisions, to profile the stores more accurately, allocate our goods better, and of course to incentivize on the cross-sell. So it's made a big difference to our business. The buyers now think this is a great thing. So the whole thing is loved not just by customers, but also by our buyers. And that's why we're able to expand it and enhance it.
Now what you're doing is you're taking all of this benefit and you're taking it to the rest of Africa. You're going to convert at least 33 stores in Botswana and Namibia this year. Maybe walk us through that process.
Look, because I think Africa is the future. Botswana and Namibia are great markets, already successful. We want them to take them back into corporate stores, so we're in negotiation on that. The Kenyan business is growing well. Those markets are the future for us. You know, it's only ever going to be 10% of our business over the next three years or so. But it's an important part of our business. It's a growing part of our business. There's no substitution within South Africa. So, you know, it is a key element of our growth strategy.
You said it's only going to be 10% of your business over the
Which is still quite a sizable sum, by the way.
Which is still quite a sizable sum. Are you looking to grow that, you know, beyond the kind of 3-year period?
I think 10 years' time will be a different picture again. You know, Africa, the other African countries will grow faster than South Africa. Our sales there will do the same, and we will build those businesses so they will become larger than 10% over time. And what we need to do is invest in the brand, invest in those stores, invest in those markets for the future. Our return in the short term won't be as good as the return we necessarily get on our South African operations, but it will be in time.
It must be a costly exercise to go from franchising to owning back those stores, and 33 stores is quite a number. Do you have a figure for me on how much this is actually going to cost?
Oh, look, we're in the middle of negotiation. I'm not going to give you the figure that we're negotiating over. It is a sizable sum, but it's a good business and we're paying a fair price for that business, and we'll get a very good IRR. So if I look at all the franchises we've bought back in South Africa, we're getting about a 20% IRR on those businesses. So buying back franchises has been successful, profitable, as well as enabling our brand to grow faster and our brand to be more controlled. So we're very happy with the buyback of franchise, South Africa and Africa.
For Botswana and Namibia specifically, do you have a timeline on when those stores will become wholly owned by you?
Hopefully it will be done during the course of next calendar year.